Vadim.
Yeah, hi, Bob.
Hey, how are you? Let me double check something. Blinking.
Okay.
Blicking.
Stain.
Stain.
Yeah, Stain.
Got it. Okay.
If you say Sheen, I'll be fine. It's not going to be it.
Listen, I have a name. People butcher my name all the time.
Yeah.
Right. Do you guys see the screen?
Do you, Bad?
I do too. So So I guess how would we control the slides?
Let me first put it on to mute everybody else when they enter.
Okay.
Participant.
Is there a way also to block anyone else from accessing this until, like, let's just say 11:55 or no?
No.
Okay. Sorry.
But I'm trying to figure out how I turn this over to you again. I only did this once before. I can change your videos. No, not my video. To be
Vadim.
Okay, that's what I thought. So I think I just check. I right click. Yes. That's keyboard and mouse. Why is it not letting me do that though? Trying to pass the keyboard to you. And if I change your role to a presenter, here we go. Try changing the screen now, Vadim.
Let me try doing that. Hold on.
Good.
Okay,
right.
great.
Now have
that
control.
Works.
I'm recording.
Right.
I see that it says it's recording this time. We had issued that before.
And then how's the audio? I'm assuming you guys hear us well?
Yep. So,
right.
And everybody else is muted on entry, so that means that they can't talk.
Great.
And basically, if anybody's going to send in questions, they will do it on the right side under the chat bar. And you guys can chat among yourself between one another to make sure when you send a chat, you want to click, what did I just do? You want to click like a little pull down there. If you don't say if on an email Vadim right now, I just click his name and it will go straight just to him. If you leave it at everyone will see what you're right.
Gotcha. Okay.
Okay.
So basically where it says
did you see what I just sent you?
Yep. I'm going to respond.
Britt,
I'm going to respond.
Okay, Britt, did you see what I just texted to Vadim?
Nope.
Okay. So I see it. Right. So you and I can communicate.
Yep. Okay, great. So that's fine. I'm gonna go get some water, and then I guess we'll
I'll put you on speaker, and I'm just gonna sit here and wait. So, and like I said, Vadim, what we'll do, once we have, and I guess I mentioned to you that sometimes the number of people on the side is not always a good reflection of who's in. Okay, but and you seem to think there's going to be 60 people that that are going to be on this call?
No, basically the only thing that I've seen is that when I went to share the actual call-in information on my LinkedIn with my contacts, I saw that there were 69 shares, right? Now, relative to the one in December, I also took a look at that because I was just trying to hear how that call went because I wasn't on that call, and I saw that there were only 7 LinkedIn shares. I'm assuming that's going to be an indication of attendance, but
Okay. I don't think it's limited just to LinkedIn because remember, this organization has a lot of, and part of what they joined for is to participate in events like this. So they know on the calendar. So if it strikes their tickles fancy, dial in. But the thing is, we don't always know if they may not come in with a handle.
up on the calendar on the website. It goes out to members in an email. Excuse me, and then it went out in the newsletter, and then also posted on Facebook, LinkedIn groups, some other hedge fund LinkedIn groups, Hedge New York, and then we record it, and we're going to put these up on the website as podcasts for the future. There are several journalists who have expressed interest, and I know that they might not call in because sometimes you get busy, but just so you know.
Okay.
Great. Yeah. No, absolutely. And we also don't know how many people are just going to obviously view this over a podcast, right? Just like a DVR.
Mm-hmm.
Right.
Yeah.
Can you hear me? Just put you on speaker.
Okay.
Can you hear me?
Yes, I could hear you.
Mm-hmm.
Can you hear me clearly?
Yes.
Yep.
Okay, so I may leave it on speaker then.
Right.
Okay. And like I
great.
said, Pat, I will try to help you keep the ball bouncing.
Great. No, appreciate it. Thanks a lot, Bob. So looking forward to this. All right, I'm going to mute ourselves from our end. Just going to get some water, and then I guess we'll get started in like 15 minutes or so.
Yep.
Like I said, I think people start showing up around noon. We'll give them a 5-minute grace period if we need to, but no later than 12:05 we kick off.
Okay.
Thank you.
Thank you.
Hello. If you don't mind, we're going to give everyone just a minute or two before we start. Okay. I'd like to welcome everyone to the January 2017 New York Hedge Fund Roundtable we call. I am Robert Atkinson, COO of Mirae Asset Securities. We are delighted that Vadim Blickstein, Baker Tilly, is joining us. Now, Baker Tilly, of course, is a leading full-service accounting and advisory firm. Vadim, who is a CPA at the firm, specializes in providing tax advisory and compliance services to hedge fund, private equity, and investment management groups. Now, Vadim's topic today is going to be, what does a Trump administration and Republican Congress mean for your tax planning? Now, I think you all know, election cycles in this country run every 4 years, and we're pretty much conditioned to that fact. However, I don't think it would be a stretch to say that this last election cycle has been extraordinary by virtually any standard. And I don't mean that to imply any type of value judgment, of course. So without further ado, I'd like to introduce Vadim. Vadim, are you there?
Yeah. Thanks, Bob. First and foremost, I'd like to thank you and the rest of the Hedge Fund Roundtable team for giving this opportunity for us to speak. And I think without further ado, maybe let's just get into the content and the slides and go from there.
Again, just to remind everyone that when Vadim is done, there will be ample time for Q&A. Now, I do have some questions from some eager beavers in the audience already, but there's a facility there to send questions in. So please continue, Vadim.
Okay. So I think before actually getting into the meat of the tax plans, I think it would be appropriate for us to discuss why tax reform is needed, right? So currently what we have is a situation whereby the corporate tax rates in the U.S. are amongst the highest in the developed world. I think we're actually probably the third or second highest in the developed world, depending on how pending legislation will actually pan out. We're also an outlier in the G7 and most of the OECD as it pertains to our taxation regime on worldwide profits for corporations. We are the only country in the G7 that has a worldwide taxation regime, which means we tax companies both on profits that they make within the country and on profits that they repatriate back from foreign subsidiaries in the U.S. I think another thing, and this is something that we hear oftentimes from foreign fund managers that are just starting up funds here, and I'm sure you guys have similar feedback. The Internal Revenue Code is arguably amongst the most complex in the developed world. When you take into account how much it's grown and how much more sophisticated and complex it's gotten, couple that with another 50 different tax regimes in the states that need to be taken into account, it could be overwhelming. For example, oftentimes we have, let's just say UK or Australian hedge fund managers that just start up here in the U.S., and they're always overwhelmed as to the sort of complexity and sophistication that's needed to have a tax structure here in the U.S. relative to, let's just say, Australia, the Cayman Islands, or even in the U.K. And I think first and foremost, I think this election has really taught a lot of people that it's not only service businesses that are voting, and it's really the manufacturing states that a lot of our politicians may or may not have paid as much attention to in the past. I really feel like a lot of these proposals, and we as a firm feel that a lot of these proposals are aimed towards bringing manufacturing back and not only service businesses. And there's really a desire to promote economic growth by creating incentives for primarily manufacturing companies and business incentive in the United States. Okay. So I think what's also important to also understand is how is the tax reform, both the Republican blueprint and the tax reform proposal from what we have from the new administration, how is it going to affect the asset management industry and the participants and the investments and also our investors? I think what we're going to be doing in this presentation is answering these questions. Which corporations are going to be benefiting from lower tax rates? Which industries are going to be benefiting most from this? Are lower tax rates just going to be aimed at high net worth individuals, or is it going to be aimed at a more broader tax base? We're also hearing a lot of these proposals and how they discuss broadening the tax base and eliminating a lot of the deductions that a lot of companies and both individuals alike currently benefit from. So we're going to discuss who could be the potential winners and the potential losers from that regime. And also, and I think the main question, at least what we hear from clients and prospects, is what's going to happen to carried interest. I think that's paramount in pretty much discussions that we have in the asset management industry, and really whether or not this is something that's going to be here to stay, or are we actually serious, both from the Republican standpoint and the new administration, as to whether or not this tax advantage is going to get repealed. So first and foremost, what I like to do is concentrate on both the Trump plan and the House Republican blueprint and how it compares to the current tax regime we have from a business, a corporate business, a pass-through business, and an international standpoint. Okay? Currently, what we have now is U.S. corporate rates. The maximum statutory rates are now 35%. Under the Trump plan, he's proposing a 15% tax rate and an alternative corporate minimum tax regime to be repealed. The Republicans are currently proposing a 20% tax rate and also the AMT being repealed for corporations. Currently, what we've been noticing in the past decade or two is that there's been a trend not to sort of shy away from corporations, primarily because of the tax rates and the tax regime that's currently in place for corporations, and more pass-through entities. Right now, about, depending on how you measure it, almost 40 to 60% of the entities in the United States are a pass-through entity in some shape or form, primarily limited partnerships and LLCs. Right now, the current tax rate that we have for pass-throughs is 39.6%, and that's akin to the same tax rate that you would have for an individual. As far as the proposals that Trump is sort of indicating that he will do for pass-through entities is that they will have a 15% tax rate to the extent that they will be reinvesting the profits that they earn. Otherwise, they would be subject to a 25% tax rate for all other income. Now, the Republicans and in the blueprint, what they're out with is that it's going to be a 25% tax rate for all partnerships and other pass-through entities. They did also indicate that in order to prevent abuse in this regime, that there is going to be a reasonable compensation requirement. That is, if currently you're an employee and you're going to be taxed at 39.6%, then you're not simply just going to be setting up a partnership to be the actual employee of record and to only benefit from the 25% tax rate. So I think as it pertains to whether or not there's going to be a loophole associated with that, I think the Republicans are going to be covering that, and I think that that's something that we should all be expecting in the new legislation. Now, as it pertains to taxation of future foreign corporate earnings, this is something that we hear a lot because really the way the regime works right now is that if you repatriate profits back in the United States, you would be subject to a 35% tax rate, more or less, but you will be getting some benefit from foreign tax credits based on taxes that you pay on that income in a foreign jurisdiction that you're doing business in. So currently what we've been hearing a lot about is the Googles, the Facebooks, and the vast majority of the S&P 500 parking their foreign tax profits, which more or less comprise almost 70% of their earnings of the S&P 500, at least the large caps. And they're basically harboring them in offshore tax havens or European jurisdictions like the Netherlands or Ireland. So what the Trump administration is essentially saying is, instead of having this deferral feature, which means you're only going to be taxed when you repatriate earnings back to the United States, what you're going to have is a tax on wherever you make the money, whether it's going to be in a foreign jurisdiction or a U.S. jurisdiction, but the tax rate is going to be much lower, and it's going to be at 10%. What the Republicans are actually proposing is going to be something a little bit different, and this is something that we're going to be talking about in detail. What they're saying is if you're going to be making profits in, let's just say, Europe or the Pacific Rim or any other jurisdiction outside of the United States, 100% of those dividends will not be taxed. This is going to be more of a destination tax regime and more of a territorial system as opposed to the worldwide taxation regime that we've been used to. What they're also proposing, and this is something interesting, and we're getting more and more details about this, as the nominees are being nominated, and we're actually seeing that both the Republicans and the Trump administration are going to be discussing this in Philadelphia within the next coming days, is something called border tax adjustments for importers and exporters. So what that essentially means is that any single time that you're going to be importing goods or inventory, for that matter, from a country outside of the United States, you're going to be denied a deduction for purchasing that good or service. Now, as it pertains to exporters, what they're going to do on the other side of the coin is that any single time that you export a product, whether it would be a car, whether it would be a plane from the United States, conversely, you're not going to be required to include the income associated with that sale in your taxable income. So this is something that we're also going to be discussing further in a lot of slides, and we're also going to be discussing who's really going to be benefiting from a system like that versus who's actually going to, basically who that's going to be a detriment for. The last bullet point here is taxation of current foreign corporate earnings. And this has something to do with the repatriation holidays that we've had in the past, and something that both the Republicans and Trump administration is discussing now. So what they're essentially saying is that the trillions that we have in offshore earnings that are currently held by U.S. corporations, what Trump is saying is that that the new administration is proposing to put mandatory tax of 10% on all those earnings, whether they repatriate them or whether or not they keep them offshore. Now, what the Republicans are proposing, and we believe as a firm that this is going to be a little bit more realistic to actually pass, it's going to be a mandatory tax of 8.75% of all corporate earnings held offshore, as long as that they're held in cash or cash equivalents, and that's going to be regardless of whether or not we repatriate them or not. And there's also going to be a 3.5 tax on all other earnings, meaning if you profits but you're reinvesting these profits in the foreign jurisdictions that, let's just say, you do business in, what's going to happen is that there's going to be a 3.5% tax on those earnings, and that's going to be something that's going to be payable over 8 years. One thing that I do want to mention, that this applies to just current earnings that have been there and held offshore before 2017. Okay, now some more business and tax provisions and international tax provisions that both the Trump administration and the new Republican House has. It really pertains to business investments and capital investments. So currently what we have is a rule whereby the first $500,000 of assets could be expensed for most businesses that acquire them, and they could be expensed currently as opposed to being depreciated over a period of time. Then there's also another rule called bonus depreciation, which allows businesses that exceed the $500,000 threshold to expense 50% of the acquisition costs of an asset that they place in service in the United States. The Trump plan is actually calling for is that there are going to be no limits on infrastructure or acquisitions of business assets as it pertains to expensing them in the year that you acquire them. So, for instance, what does that really mean? If, just say, Ford opens up an auto manufacturing plant and they're paying $2 billion to open that up, instead of capitalizing that cost over, let's just say, 10 to 15 years, they will be able to immediately deduct that cost in the year that they actually incur it under the Trump plan. Now, what the Republicans are calling for is that you could also immediately expense all tangible and intangible assets that you're going to be acquiring, but they do also indicate that there's going to be an exception for land. For instance, if you're going to be buying land for a factory, that's going to be something you cannot expense, and that's not going to be something that's going to be depreciated, as what's currently in the code that we have right now. Another thing that's interesting is right now we have a regime from both the current regime that's really has been in place for the past 20 and 30 years that really for most companies to prefer debt over equity. The reason for that is in most situations the current tax code allows you to take a tax deduction on any interest expenses that you pay on debt that you issue. Now, both the Republican House and the Trump and the new administration really call, as it pertains to this deduction, what they're basically saying is that if you elect to take the benefit of immediately capitalizing and expensing all your assets in the year that you acquire them, you no longer take an interest deduction on debt that you have outstanding. Now, what the Republicans are saying, they're going a little bit further, and they're just saying, regardless of what you do as it pertains to capitalizing or expensing assets that you're going to be acquiring in the year, you're not going to be allowed a deduction for interest expenses to the extent that they exceed your interest income. So that's going to be very important, and that's going to be very pivotal for many corporations that have a large debt. Because, for instance, let's just say General Electric says that they have 30 million bonds outstanding. If they have an interest rate of 10% that they're paying out on those bonds, they'll be losing out on a $3 million deduction annually. $3 billion deduction annually to the extent that they do not have interest income to offset that interest expense. So that's going to be something interesting, and I think that we as a firm really believe that that's going to have a very large effect on what's going to be happening with future debt issuance, also future tax structures, and there's probably going to be more of a preference for equity funding as opposed to debt issuance. Also, as it pertains to paying for all of these in corporate tax rates and business tax rates overall, what both the Trump administration and the Republican administration is proposing is that pretty much all other expense deductions that create a lot of corporations and businesses benefit from, particularly as it pertains to things like renewable energy credits, things like residential energy investments and things of that nature, and other programs aside from research and development credits, that's something that they're going to be eliminating to help pay for a reduction in overall statutory tax rates. So I think what's important to understand is who would be the winners and the losers of both these proposals. What we currently believe, and assuming that these proposals pass as they are right now, businesses that are really net exporters, industries such as aerospace, chips, energy, chemicals, agriculture, and pharma would benefit the most, largely because they manufacture here in the United States and they primarily export, and they derive a large part of their sales from exports here in the U.S. Now, businesses that produce largely in the United States and also make large capital investment here in the United States would clearly benefit from these proposals as well, simply because you're going to be getting an immediate benefit for the acquisition of assets that they can spend against their income in the current year, as opposed to depreciating them like they currently do for tax purposes over a period of time. Businesses that also rely on equity funding, they clearly benefit just because they would not lose out on interest deductions that are currently in play in the current tax regime. And we also believe that equity market operators like the New York Stock Exchange and NASDAQ would be a prime beneficiary of this new tax proposal as well, simply because we believe that there is going to be a preference that's going to shift from debt issuance by corporations and other businesses and really more equity issuances and a lot more IPOs and things of that nature. Now, depending on what's actually going to happen with pass-throughs, we largely believe that they are partnerships and LPs and LLCs will largely benefit from the proposals as well, as they currently are, just because they will also be able to utilize lower statutory rates on the income that they earn. Now, some of the losers that we believe as a firm that are going to particularly be hurt by these proposals are really the retailers of the world, electronics manufacturers, some auto manufacturers that primarily import. For example, let's just say Volkswagen right now only produces 20% of the models that they sell in the United States here in the U.S., and the vast majority of them are imported from Mexico and Europe. And we also believe that apparel manufacturers that rely on primarily Asian markets and some European markets for the manufacture of their goods could also lose out, and refiners, just primarily because a lot of them still import oil from other jurisdictions other than the United States. Now, from the fund world, where we think that there's going to be a potential change in strategy simply because of the tax effects of these new proposals, is really going to be the fund managers that extensively use leverage. So what happened before, whereas the fund managers that were using leverage in their strategies, they were basically allocating an interest expense deduction to their investors and partners that may or may not no longer be there and it may not be available, thus lowering the attractiveness of that strategy going forward. That also is going to be applying to private equity businesses that really rely on buyouts, and also as it pertains to corporate issuers or debt, simply because I think what we believe is going to happen is that, just like I mentioned before, there's going to be a preference to issuing more equity and more shares in the form of additional share offerings or IPOs, as opposed to issuing more debt, for the reason that these companies may no longer rely on interest expense deductions as they did in the past. Also, another thing to note is that potentially renewable energy businesses, whether it would be the solar manufacturers or the wind manufacturers, they may also lose out, because it appears that the tax credits that they relied upon for clean energy and solar, etc., whether it would be in residential areas or commercial areas in the country, they may no longer be there. Also, what's interesting to note is whether or not the lower tax rates would actually also apply to businesses that are sole proprietorships, meaning instead of running a partnership, you would be doing business on your own, and you have your own employees, but we believe that it's very likely that the tax rates and the tax regime changes to pass-throughs would also apply to sole proprietors. Another thing, and this is something that we've been hearing in the news, large businesses like, to say, the Citibanks of the world that were relying on large deferred tax assets because NOLs that they incurred in the past that they want to carry forward to offset future income. We believe that there are going to be valuation allowances to those simply because you're not going to be worth as much as they used to be worth before if corporate tax rates do indeed go down. Some answered questions. There's a lot of speculation as to what these actual tax proposals will look like when they get passed and what effect that they would have. Right now, what we're seeing is just a blueprint, and it's really light on the details. So there are plenty of unanswered questions for both pass-through entities and corporations, and some of them are on this slide. I think first and foremost is if tax rates change for partnerships, LLCs, and limited partnerships, whether or not there's going to be an actual tax at the entity level as opposed to the partner or shareholder level. Also, another question is, if there is going to be an entity tax, whether or not corporate partners would be benefiting at their tax rate, or whether or not they're going to have to be paying the pass-through tax rate. Another thing to keep in mind is whether or not these business tax provisions regarding the border tax adjustments that particularly benefit importers and are really a detriment to more import-reliant businesses, whether or not they're also going to be applying to pass-through entities or just corporations. And also, what is really meant to be reasonable compensation at a partnership that's primarily a service business. That would really apply to asset management companies, law firms, and accounting firms, and consulting firms. Now, some unanswered corporations that we believe that there are as a firm for corporations would be whether or not this notion of border tax adjustments that would primarily benefit exporters, whether or not that would be something that would be compliant under the current World Trade Organization rules. Another item to know is how would foreign branches and not foreign subsidiaries of corporations will be treated, and also how would exporters of products here from the United States also be treated as it pertains to the border tax adjustments. Because I think it's easy to also forget that although we export the vast majority of the aerospace products that we have from the United States, particularly Boeing, a lot of these aerospace products depend on a lot of imports, and they also have a substantial amount of foreign components that are made abroad. So we'll see whether or not these products would be penalized as well, or whether or not there is going to be a lot more suppliers that will be moving here in the United States as a result of this. And I think that we certainly really need more clarity on is what these border tax adjustments would imply for service-oriented businesses. For example, if you have financial services firms like banks or asset management companies doing business in Europe, whether or not we would be hurt or whether we would benefit. Also, likewise, if you're going to be utilizing service providers, let's say like Canadian law firms or UK financial institutions, whether or not that's going to be something that's going to be considered an import or that's just not going to be addressed in the border tax adjustment rules will really be for the traditional trader business. Now, I think what we're going to be moving on to is how the individual tax provisions would change as well, particularly as it pertains to the investors of the asset management companies that we currently have, and also as it pertains to the fund principals. So what we're seeing now is currently we have a regime whereby we have 7 tax brackets. What Trump is proposing and both the Republicans are proposing is really minimizing those tax brackets and making it far less complex to 3. They're also going to be reducing maximum statutory rate 6.6% to 33% for both proposals. As pertains to capital gains and dividends, currently we have a tax rate of 23.8%, of which 3.8% relates to a net investment income tax that really happened as a result of Obamacare. What Trump is proposing is to leave the current rate for capital gains and dividends at 20%. However, he would repeal the 3.8% surcharge. What the Republicans are proposing is have the rate for capital gains and dividends from that of ordinary rates. So that would move the maximum statutory rates for this type of income to 16.5%. And obviously, I think, as most of us know, that they're also a big believer in repealing Obamacare and the 3.8 surcharge associated with that. Now, as it pertains to carried interest, we're going to talk about more about that in some additional slides. What we're currently seeing right now is that in the Republican House blueprint, this is not mentioned at all. They do mention anything as it pertains to carried interest, what they're going to do with that as it relates to private equity funds and hedge funds. But the Trump plan, as he came throughout and as his Treasury Secretary nominee recently just said at the hearings and the nomination ceremonies, is that they want and that they intend for carried interest to be taxed as ordinary income. So I think more is to come on that, and we'll see what's really going to happen with that. Now, as it pertains to state tax, what happens now is that where we have in the current regime, if you have, let's just say, a high net worth family that passes, primarily most of their assets are held in the state, and before those assets get passed on to their heirs, to the extent that they exceed a certain threshold, which is currently $10.9 million for married filing jointly filers, there is a 40% tax. Now, what Trump is calling for is to repeal the tax, but also saying that the step up in basis that most people benefit from when they pay the tax will also get removed. That is, for example, if you inherited dollars of stock that cost your parents $500,000, what is that it's going to go to you tax-free. However, your cost basis is still going to remain at $500,000 and not at $2 million. So until you actually sell those assets that you inherited, there will not be a tax associated with that. What the Republicans are saying is that this will be completely repealed, and I think more is to come on this. Now, just like discussed in the beginning of this presentation, they are really discussing broadening the tax base for both individuals and corporations alike. What this really means is really in order to pay for these and in order to pay for these lower maximum statutory rates and to make these proposals more or less budget neutral, that means eliminating a lot of the deductions that we currently rely on. What the Republicans are calling for is to eliminate state tax deductions entirely and to modify or further limit other deductions like mortgage interest and real estate taxes. Now, what the Trump plan is calling for is to cap any itemized deductions at $200,000, and then married filing jointly filers. The charity deduction will not be capped, and they're also indicating that anything in excess of that threshold will not be deductible for a taxpayer. Both the Trump and the Republican House blueprint are calling for alternative minimum tax to get repealed just to simplify the tax code as we have it now. So what we did here, I think it's also important for everyone, aside from actually knowing what the proposals are, really just to put numbers to them and really just to emphasize what this really is going to mean to different taxpayers. So here we have an example whereby we have a fund manager that is essentially receiving $3 million of wages, $1 million of qualified dividends, and $10 million of long-term capital gains. If this manager lived here in New York City, they would be effectively paying a $1.8 million tax in New York. So under the current regime, as everyone is seeing in this example, the total federal taxes for this individual would be $3.1 million. Now, under the Trump plan, although the maximum statutory rates are going down, as you see, as it pertains to the taxation on the income, it's really going to be more or less tax neutral, simply because he's capping item tax deductions at $200,000, which means that the vast majority of New York and New York City state taxes would not really be offset against a deduction against taxable income. So taxable income for a fund manager living in New York City will not really change much under this fact pattern under the Trump plan. Now, what the Republicans are calling for is a further deduction and rate decrease for capital gain income. So here, there's more or less a $300,000 or $400,000 benefit under the Republican blueprint if it stays as is. Interestingly to know, if you have that same fund manager, if he lived in Miami or Dallas, he would be a prime beneficiary of both the plans. Currently under the tax code, both Florida and Texas do not have state taxes, so they do not receive any benefit for paying state taxes. So under the current tax code in this scenario, they would be paying $3.8 million in federal taxes. However, under the Trump plan, they would be paying $3.2 million. And as you can see, they're going to be a prime beneficiary of the reduction of statutory rates, and they're not going to be impacted whatsoever as it pertains to the elimination of state tax deductions. And also, under the Republican blueprint, they would be paying even less, $2.8 million. So really what's happening right now is that both Republican proposal and the Trump proposal are really going to be having a lot more of an effect and an overall tax decrease as it pertains to fund managers and high net worth individuals living outside of high tax state jurisdictions. I do want to note, and for any of us really going and listening to this call after the podcast, there are lots of assumptions in the tax impact models that I just discussed. First and foremost, I use maximum statutory rates. I'm also assuming that all capital gains and dividends are coming from direct investments and not from pass-throughs, which they typically do in the current tax code. Most fund managers really operate through partnerships, so they would also benefit from much further reduction in capital gain and dividend rates, and also ordinary income as it pertains to the business income that they earn from their partnership investments. This also doesn't include potential itemized deductions, limitations that are currently in the code, and nor does it discuss anything as it pertains to AMT considerations that are currently in the code. So I just want to say that just because everyone's personal tax situation is different, I wouldn't want anyone on this call to apply these models to themselves, and I would really suggest that you would consult with your own personal tax advisor as it pertains to knowing how these proposals would affect you. Okay, now as far as winners and losers, as in the individual tax provisions that both the Trump administration and the Republican blueprint have, what we believe as a firm is that primarily high net worth individuals with large investment income would be prime beneficiaries. Elderly, high net worth families with large estates would clearly be beneficiaries because of the estate tax repeal, and most high net worth wage earners. There's going to be a lot more of a preference to those wage earners if they live outside of high tax state jurisdictions like New York City, like California. Now, some of the losers from these proposals we believe could potentially be not really beneficiaries of this would be trader funds that are not really heavy traders, because there's going to be a further cap on itemized deductions and whether or not your investors and your partnerships in the funds that you have, whether or not they could benefit from those, particularly as it pertains to management fee expenses and other fund level expenses. If they're going to be capping itemized deductions at either $200,000 or whether or not they might eliminate that altogether, that's certainly going to be a detriment as far as whether or not your investors will be benefiting from an allocation of these expenses. Another thing, and this is something that we talked about as a constant theme, is high net worth individuals that are living in states with high income tax rates. They potentially could actually lose out on a net basis, depending on how their income is and how high their state tax rates are as pertains to the current regime. And also, carried interest beneficiaries, fund managers, and their employees could potentially lose out if they repeal carried interest as we know it now. All right, so some takeaways that would directly affect most people on this call and the fund managers and both their compliance departments alike is both the Trump administration and the Republican House blueprint, what they're essentially saying is that they want to roll back as much regulation as they can. What this really means, and I know that this is going to be sort of a sigh of relief for a lot of fund managers on this call and their compliance officers, is there have been talks of FATCA being repealed altogether, the new 871M regulations as it pertains to dividend equivalent payments. Also, I think a key takeaway would be the potential removal of the carried interest tax advantage, simply because it doesn't look like they may actually still stay into place, because they're one way or another, most people are viewing this as low-hanging fruit, and they're going to need to pay for the reduction in maximum statutory rates. What we do believe, however, is that the removal of the carried tax interest advantage would be further lessened, simply because the gap between capital gain rates and dividend rates will also decrease, and there is going to be an overall decrease in maximum statutory rates. So we think that the impact of this to fund managers will be lessened considerably. Long-term value and activist investor funds, I think there potentially could be pushback from investors, simply because if you're not going to be a heavy trader fund, a lot of your expenses that your investors had the opportunity to deduct before may be further capped, and that could result in some more difficult conversations as to whether or not we should be moving to more of a high trader or much more active portfolio management. Now, this is also going to be impacting fund managers that are highly leveraged, particularly if they're long-term investors, because the interest expense, as we know it now, that's otherwise allocated to partners, would be going away under both regimes. And I think this thing, and this is something that we've been hearing both from Davos and the World Trade Organization and the OECD, is really how the world and equity markets would react to what could be perceived as more America first and more business-driven plans that could potentially really get into nitty-gritty of trade wars associated with other countries, especially if the border tax adjustments that they're currently proposing will go through, because what it will do is that it would encourage businesses to export, and a lot of these businesses that really predominantly rely on imports from other jurisdictions from inventory, particularly in the retail space, they're really essentially going to have much more of a motivation to buy from U.S. manufacturers, simply because there's going to be a deduction denial for any imports coming from foreign countries. Again, one thing we want to caveat as a firm, and I especially want to say, is really these are just proposals. So we know what's actually going to happen, but really the purpose of this seminar and this presentation is to give you and sort of a look to how it's going to be affecting your world, your clients, your investors, based on the proposals as we currently see them now. So I think that sums this up, and I know, Bob, you said you had some questions already pre-planned that you had from some of the constituents on the phone.
So first of all, Vadim, I want to for a very clear and concise treatment of what is a very ranging and relevant topic. Well done. Thank you. Why don't we start off with this one? campaign, then candidate Trump had indicated in fairly clear terms that he wanted to eliminate carried interest in one way, shape, or form. And so my question to you is, since he's been inaugurated, has the position changed? Has it modified? Has it softened somewhat?
Okay. So basically, I think this is a question that's paramount to most of our clients as well, and I'm sure a lot of people on this call. What we've heard thus far is nothing really from Trump himself, and also the Republican House. Now, there are some rumors as it pertains to members of the cabinet that, for example, his Treasury Secretary nominee during his nomination hearings, he was essentially saying that he intends to roll back this tax advantage. So we very likely may not see this as it pertains to the Trump administration and its stance on carried interest. Now, there was a rumor last week that actually came out from a news resource that Paul Ryan and the rest of the Republican House, they were also indicating that they might do away with the carried interest advantage, but when actually spoken to, and his spokesman actually came out and said truly that the House Blueprint Plan currently does not address carried interest, and as of now they do not intend to do anything other than the Blueprint Plan as it is. So I think we're really more or less in a wait-and-see mode, and I think there's more yet to come on this, and we'll see what's actually going to happen.
Okay, thank you. And let's move on here. So, we've heard a lot, and you alluded to this, at least indirectly, the America First theme of the Trump administration. So let's talk about border taxes for a moment. First of all, what exactly is a border tax, and what is the likelihood that we're going to see a border tax?
So this is certainly going to be a very interesting point of frustration for both the Republican regime and the new administration, simply because there's been a lot of chatter as to who this is going to really affect, whether or not the consumer is going to be restocked with the brunt of this tax, and whether or not retailers would be really moving the expense associated with this tax to the consumers. So what the border tax essentially is, it's a tool for Republicans and the administration to primarily really heavily incentivize domestic production of goods sold here. So basically the intent is anything that's being sold to U.S. consumers, they want it to be produced here. What they're essentially going to be doing and what they're proposing is very similar to that of a VAT tax that we currently have in other European countries and most of the OECD, is that essentially when you're going to be, say, importing a car from Mexico, to the extent that the vast majority of that cost really has very little U.S.-made components in that car, the person that's actually the entity that's going to be purchasing that car is going to be denied a deduction for that import. Now, vice versa, let's just say we have BMW exporting SUVs out of South Carolina. To the extent that they're going to continue to use that as their hub for exports of SUVs and cars of that like, essentially the income that they're going to be earning from the sale of those exports would be exempt from being put into taxable income. So as you can imagine, there are going to be clear winners and losers here, and certainly if any portion of this plan is actually going to go through, and as far as the likelihood, we'll see as it pertains to what the final drafting of this agreement would be, then it's certainly going to be favoring domestic production. One thing that we did find out recently is that, and I think most of you have heard this, is that the new administration was essentially saying that this was really too complex, it's going to be hard to understand, and really how are you going to know how much of the contents and the components in a product that you're exporting was made in the U.S. versus that of a foreign jurisdiction. So I think as you can imagine, this would really help out as it pertains to moving a lot of this production back onshore here in the U.S., but as it pertains to making the tax code more simple, I think, and we as a firm certainly think that this is not going to be achieving that.
And if I can just follow up on that border tax question, and your point about the complexity of attempting to assess it. The example you used is South Carolina BMW. What about the state of Texas? My understanding is that Texas, one of the reasons that the Texas economy has been so robust has to do with its position geographically in the NAFTA highway. Okay,
Mm-hmm.
What do lawmakers like Texas think of this?
Yeah, so it really depends. It really depends who your constituents are. Clearly, Texas is it's the largest exporter of products that we have in the United States. So clearly, especially the energy companies that export natural gas and oil, as of now, shale oil in particular, to foreign jurisdictions would be prime beneficiaries of that. Now, on the other side of the coin, Texas is also the largest state that, from a nominal standpoint and a volume standpoint, that receives imports from Mexico. So that's going to adversely impact the importers there, particularly in the retail space, and also potentially the auto space. For example, let's just say that the Toyota Tundras that are currently made in Texas, if they rely highly on components in Japan and from Mexico, that Toyota may be denied a deduction for importing those components, and that could clearly increase the price of this vehicle to that of the ultimate end U.S. consumer. So I think it's going to be affecting both on a positive standpoint and both as a detriment to importers and exporters in Texas, and it's going to be interesting to see how this is going to pan out.
Okay, so let's lift gears for a moment here. Let's talk about real estate. I think many on the phone here are in either the real estate market or have investments that cater to residential home buyers. What's your view on how or if the mortgage deduction tax provisions will be affected by the tax proposals announced from Congress and the new Trump administration?
So I think this is a good question. This is certainly on the minds of a lot of real estate investors, both in the commercial space and clearly the residential space. So in large part, the mortgage interest deduction, we believe, is going to stay intact based on the proposals that we currently have as it pertains to middle class and lower income class families. Now, as it pertains to high net worth individuals, which disproportionately benefit from this deduction, we believe that this is going to adversely impact them. So I think to answer your question, first I just want to make sure everyone is aware as far as what the current administration and the current tax code calls for deductibility of mortgage interest. So essentially what we have now, if you have a mortgage of $1.1 million or more, including home equity lines, the interest as pertains to the portion that's over that threshold is no longer deductible and has not been deductible for some time. Now, the interest on anything lower than $1.1 million and basically the threshold, the mortgage that you currently have that's below that threshold is currently deductible. So what basically both plans are really calling for is that anyone that already has, let's say the new administration is coming out with a plan that's saying that they're going to cap deductions to $200,000. So say, for example, you are an average Manhattan family, per se, and you're making $1 million or $2 million a year. I don't know if I would call that average, but certainly for some of the clients that we currently have, and also for some of the people listening in. What's happened is that you already pay a lot of state and city taxes that are used as an itemized deduction. So essentially, if you're going to be utilizing that itemized deduction via the state and city deductions that you currently have to pay in the form of income taxes, you're no longer going to really be able to benefit at all from the mortgage interest tax deduction if you use up $200,000 or more of it.
So look, you spent a great deal of time talking about how these tax proposals benefit or possibly disadvantage managers, the folks making $1 million, $2 million a year, et cetera, et cetera. But what about the average American consumer? Okay, and before to that question, What is your definition of high net worth from an income standpoint?
From
Be sure
an
to
income-
high net worth throughout the presentation. So just give us a bearing point here.
Yeah, from pertaining to tax, I think what we'd normally call high net worth individuals would really be people either earning more than $1 million a year or have already accreted a certain amount of wealth in the form of $5 million or more, and are still earning substantial amounts of income from investments, even if they're not currently making more than $1 million a year.
So how does the household with $200,000, how are they affected?
Yeah, so let's just say you have a New York family that's living in the suburbs, and they have a gross household income of $200,000 and live with 2 kids, right? Generally, under both the Republican plan and the Trump administration, it will largely benefit from the current tax proposals, simply because what they're doing is $200,000 itemized tax deduction cap is really going to be affecting people that have deductions and pay taxes over that threshold. So clearly that's not going to be the average suburban family here in New York. And because of that, they would be benefiting from lower tax rates, primarily because the overall tax rates will be decreasing, and there are going to be 3 tax brackets as opposed to 7. So in my example, let's just say you're a New York family, you have $200,000 and you're living in the suburbs with 2 kids. Generally speaking, more or less, under the new administration tax plan, you would benefit, I want to say, your federal tax burden would be reduced by 1 or 2, maybe even 3,000, and under the Republican House blueprint, your federal tax burden would be reduced by $1,000. Might not seem like much, but I think to many of us, getting $3,000 more a year from a reduction of taxes could mean a lot as it pertains to consumer spending and just overall as far as things that we'd like to see and do.
Okay. So earlier, Vadim, I know that you mentioned that you are not clairvoyant. Okay. However, I can resist, even though we're in the early stages of this new cycle, so to speak. You've been around a while. You're close to the action here, and you've covered a lot of territory here. So, with the proposals, do you think have a higher likelihood of getting passed and actually being turned into law?
No. Yeah, look, I think that's a great question. I wish I had a crystal ball and knew the answer to that, because certainly that's going to help a lot of my clients and the firm as it pertains to tax planning and what we should be expecting and doing now. What we do think is highly likely is the corporate tax reform positions and proposals that they currently have. We do think that those are having a very high likelihood of getting passed. Also, as it pertains to some form of individual tax reform, particularly as it pertains to the repeal of the 3.8 surcharge that a lot of high net worth individuals pay on investment income, that very likely may get repealed or reduced in some form or fashion, depending on what the next health care plan would look like. And we also think that it's highly likely that the maximum statutory rates would get decreased to 33% as opposed to its current 39.6%. And largely, we largely believe that this is really reminiscent of what the tax policy was before Obama and the Democrats came into office, and really similar to what we had during the Bush years, or some of them for that matter.
Sort of back to the future.
Yeah, or really, I would put that differently, maybe just going back to the past, right? Going back to some of the proposals that we had during the Bush administration. Okay.
In interest of time here, I think I want to thank Vadim for a very incisive and thoughtful presentation. This is a very broad and important topic, and I think you did a terrific job covering it in a very brief span of time. I would encourage anyone in the audience, Vadim's contact information is contained here, to please reach out to him. I do, again, want to thank him on behalf of the New York Hedge Fund Roundtable and, of course, our sponsors. Until we meet again next month, thank you all, and again, thank you, Vadim.
Thank you, Bob, and to the team at the Hedge Fund Roundtable for having us.
Folks, have a good month, everybody. Bye-bye.
Thank you. Bye-bye.